Hello, Prabhu. Good evening. Please confirm. Am I audible? All the online students, kindly confirm. Yes, everyone, kindly confirm. Am I audible? And please check is the video and the audio clear. Okay, Vishnu, you're here again. Good to see you. Let me check. Yes, I guess it is completely okay. And we should start. Okay, the students are still joining. Okay, just one more minute and we'll start. Yes, good evening, everyone. Yes, as you all know that we are starting with the revision series for CFR, absolutely for CMA Final students. So today we'll be starting with the first NDS, that is NDS 16, one of the easy NDS, which will be covering it today itself. Okay, and my pattern of teaching will be very basic one, that is I'll be covering all the concepts, and if at all there is necessity for a question on that concept, I'll be taking that itself, and after that I'll be revising all the questions also. Okay, so that you get a brief idea of what all about the IND AS is, and then we'll continue. Sorry, let's start. Okay, so we are starting with the new IND AS today, and that is IND AS 16, property, plant, and equipment. In short, PPE. Now, what is PPE exactly? So, in total, we have to cover 12 to 13 points in this. 12 to 13 points. Just 1 minute. Uh, Vishnu, you'll be getting the notes by today itself. Yes, you'll get the notes today itself. Okay, let's start. Okay, so not talking about STM now. It's completely for FR now. Okay. Yeah. Okay, so we are starting with the new IND AS now, and that is IND AS 16 PPE, property, plant, and equipment. PPE itself, right? So in total, we have to cover 12 to 13 points. 12 to 13 points. And after covering this 12 to 13 points, I'll be also taking the important questions in which all the concepts will be covered. Okay, so let's start, not wasting time. Definition. What is the definition of PPE? Exactly what is PPE? So PPE is nothing but which is tangible, because intangible is not covered over here. Intangible is intangible 38, India is 38, right? Next, it should be held for use. Held for use where? In the production or supply, for rental, or for admin purpose. That means if there is building or the machinery, if you are giving it for rent or using, or the furniture or the printer or the laptops you are using for admin purposes, they are all PPE. Next, expected to be used for more than one period. Obviously, it should be a fixed asset. It should be used for more than 12 months. Yes, Mihir, everything will be covered. Yeah. So tangible, held for use, and expected to be for more than 12 months. Simple, tangible, held for use, and 12 months more. That is more than 12 months. It is a fixed asset. That is PPE. It should not be intangible. It should be tangible, held for use. Held for use where? In the production or supply, or for rental, or for any admin purpose. Okay. There is one more definition known as bearer plant. Now, what is a bearer plant? I'll explain you over here. Bearer plant comes under the head biological assets. Biological assets are covered actually under Ind AS 41, that is agriculture. Now, what are exactly biological assets? Which are nothing but living plants and animals. Animals are all covered in biological assets, that is Ind AS 41. Living plants, there are 2 points. First is a bearer plant and the other is non-bearer plant. A bearer plant is covered under Ind AS 16. Now, what is exactly a bearer plant? The life of which is more than 1 year. Example, mango tree and coconut tree. Now, why these are covered in Ind AS 16 and why not in Ind AS 41? What is the exact reason? See, if I have a machinery, just 1 minute. Yeah. If I have a machinery, it will produce goods for me. It will produce goods for me, right? Same example, mango tree. Let's say I deal in, I have a fruit juice company and I also make a mango drink over there. So obviously I need mangoes, and this mango tree is acting as a machinery for it, and therefore it is covered under Ind AS 16, right? It is covered under Ind AS 16. So bearer plant is also covered under Ind AS 16. That means in the definition of PPE, bearer plant is also there. A bearer plant is nothing but a living plant whose life is more than 1 year. The point to be noted is it is not my business to sell the mango tree, right? It is not my business. Obviously, I can sell at a later stage, but my business is to be used in the production. That is, I'll use those mangoes in my production. That's why it is known as it is covered under Ind AS 16 PPE, right? Okay, moving ahead. Now, the second point. The first point we have covered is definition. I'll also make a brief idea. Definition, right? What was the definition? It should be tangible. It should be held for use. And it should be more than 12 months, right? If you want, you can make notes with me itself. I'll be taking the entire revision after this also. That is, revision may be revision. Okay. So this is the basic definition, right? Also, the bearer plant is covered under this. A bearer plant is covered under the definition of Ind AS 16, which is PPE, right? Moving ahead. Now, what is the second point? The second point is the common point for every Ind AS. For example, it can be tangible, intangible, and for investment property. All the 3 Ind AS have common points in this, and that is the recognition criteria. 2 points are there: FEB and cost. What is FEB? Future economic benefit. When I'm very much sure that now I will get the future economic benefits, at that time I shall recognize PP. And if I can measure the cost, only at that time you can record the PPE, right? Recognition is when to record. Recognition it when to record. So basically there should be 2 conditions, and both of them are very important. If any one of the conditions not satisfied, you cannot recognize the PPE into your books. Recognition criteria is for 2 points. FEB and the cost can be measured reliably. So basically we have 2 points over here. Recognition. Recognition, we have 2 points. What are the 2 points? The first point is FEB, that is future economic benefit should be there, and if you can measure the cost reliably. Cost can be measured reliably. If you are not able to measure the cost, then you will not recognize the asset into your books. You will not recognize the PPE into the books. Okay. So we have 2 points. Definition and recognition we are done. Both the conditions should be satisfied. Both the conditions. Okay. One important point over here is ownership is not important. Ownership is not important. Now you will say, sir, PPE, we should be the owners, right? We should be the owners to record the PPE. But why ownership is not important? I'll give you an example. Let's say I have a building over here, right? A VVIP building, let's say 3 BHK, 4 BHK houses and all everything. Okay. But the problem is, no one is ready to take this flats or the commercial spaces over there. I'm just giving an example, okay? Because the road over here is not that developed. I have requested the government or the local authorities to make a road over there, but they are not making. The cost of this building was, let's say, 3 crores. But no one was ready to come over there because of this road. So what I decided is to construct this road and to spend 50 lakhs over here. 50 lakhs. I paid all the expenses and constructed a road by paying 50 lakh rupees. And now, obviously, every employee of mine is coming into this and they're working in my business, in my building. Okay. Now, this 50 lakhs, can this be capitalized? The answer is yes. Although I'm not the owner of this road. Obviously, I cannot say that this road will be used only by me. That was not my property, but I'm still using that, and obviously it is open to all. Everyone will use that road. But was it necessary? Was it necessary for this building? The answer is yes. And therefore, I can capitalize this also. That is, I will say my building cost is not 3 crore, but 3 crore 50 lakhs, right? So this is the point. That is, ownership is not important. If there is future economic benefit associated with that, and if the cost can be measured reliably, obviously at that time you can record. Okay. So this was the second point. So ownership is not important for recognizing the asset. Okay. So these are the 2 points. Third point. Initial measurement. Now we have the measurement criteria. Measurement is of 2 types. Measurement is of 2 types. The first is initial measurement. What do you mean by initial measurement? Initial measurement means the recording at the first time. At what value will you record your PP initially, right? That is the initial measurement. Okay. So I'll write initial measurement over there. Initial measurement. Okay. And the second is subsequent measurement. Subsequent measurement. Okay. Now what is initial measurement? Initial measurement is always at cost. It is always at cost. Now what do you mean by cost? What to be included and what to exclude from the cost? I've given the entire list. We'll be discussing it one by one. Okay. Now there are 4 cases possible. There are 4 cases possible. The first one, purchased. The second is self-constructed. The third is exchange, and the fourth is government grant. Government grant is covered under Ind AS 20, so we don't need to study over there, right? So we will not study about the government grant. For talking about the first 3 points, if I purchase the asset, or else if I construct it, or else I'll get an exchange, right? This is also important, exchange. So I'll be talking one by one. What if I purchase? So I've given refer note 1 and 2. Let's refer the note 1 and 2. What to include in the cost and what to exclude from the cost. First point, purchase price. Purchase price, obviously the trade discount will be subtracted. For example, if I'm purchasing for 10 lakhs and 10% is the TD, I'll subtract this TD and I'll say 9 lakh is my cost, right? TD should be subtracted. Second, any non-refundable taxes. If there are refundable taxes, I will not add it. If it is non-refundable, that is, I have to pay from my pocket, it will not be refunded from anywhere. At that time, I'll add that to the cost. Third point, all directly attributable expenses which are directly associated. For example, the employees working for the construction. Okay. Next, it includes the employee cost, cost of site preparation, the delivery, the installation, cost of testing less proceeds from arising the test production. For example, if I'm testing the product, the cost is incurred for say let's say 10 lakh rupees. 10 lakh rupees. But I'm getting also the income because I was testing, I also got an income. So I'll subtract that income. Let's say 3 lakh rupees is the income. I'll add 7 lakh to the cost, testing cost, right? I'll add 7 lakh to the cost. Point to be noted over here is sometimes it may happen that the income generated is more than the testing cost. For example, the testing cost is 10 lakh, but I'm getting 12 lakh as the testing income. At that time, what will you do of this 2 lakh? Will you transfer this to P&L or will you subtract from the cost of the asset? The answer is subtract from the cost of asset. If sometimes the income is more than the cost incurred, then it will be subtracted from the cost itself. It should not be transferred to P&L. Very important. Okay, next. I've also given that the excess of net proceeds from sale produced during testing will not be credited to P&L. It will be deducted from the cost of PPE. Very important. Okay, moving ahead. It does not include. What is not included in the list? Inauguration, advertisement, any promotional expenses, the training cost to the employees, the admin or the general overheads, the initial operating losses, cost of relocating the employees, the income and related expenses for using the construction PPE. For example, if I own a land, right? The land is under construction. So what I did is, for time being, I gave this as a car parking to generate income. So will that income be reduced from the cost of PPE? The answer is no. That income is treated as a miscellaneous income, should be transferred to P&L. It should not be reduced from the cost of PPE. Okay, next. I've given the entire example also. Using a car parking site should be recognized as miscellaneous income in the statement. Cash discount is never to be subtracted from the cost. If any, it is to be transferred to P&L. Okay, fine. So these are all the costs to be added or not to be added, right? The purchase price less trade discount, any non-refundable taxes, all the directly attributable expenses. Testing should be added. Obviously, testing income should also be subtracted. Testing cost should be added and the income should be subtracted. Car park should not be subtracted. Refundable taxes should not be added. Any inauguration or the relocation or any previous losses should not be set off. It should not be subtracted. Next point is income from using the construction PP. Again, the car park, like, it should not be added. And last point is cost of decommissioning. What is decommissioning exactly? Sometimes it may happen that I have taken an asset over here. I have taken an asset for, let's say, 10 years. 10 years, right? I'll use this asset for 10 years. After that 10 years, I have to give the asset in the same position as I took. मुझे वैसे के वैसे ही चाहिए. I want the asset as it is. I have to hand over the asset as it is. So while handing it over, I need to spend something by for making it proper use. So in that case, it may happen that you have to incur some expenses. Let's say 50 lakhs. But I don't have to incur it right now. I have to incur it after the end of the life. Let's say the life is 25 years. So what I have to do is, I have to take it as the present value. I have to take it at the present value. For example, let's say the discounting factor is 10%. So what I have to do is 50 lakhs divided by 1.1 to the power 25. It will be given to you, so you don't need to calculate. It will always be given to you. You just have to add the present value to the cost. That is, the present value should always be added. I'll also give you an example of the decommissioning because that point is very important. Okay, so this is very important. It is nothing but a provision, and any provision is nothing but P&L to provision. The entry should be P&L to provision, right? Okay. Now this is nothing but, it is known as unwinding. Now what is unwinding? I'll give you an example. Okay, so here's the example. Please pay attention. Decommissioning or dismantling or site restoration. What exactly is this? Asset purchased for 10 lakhs on 1419. This is an example. Okay, 1419, I purchased an asset for 10 lakh rupees. Restoration cost after 4 years was 3 lakh. Now I have to restore the site as it is. I have to give that as it is, right? And this expenditure will be incurred not right now but after 4 years. So what I have to do is, I have to take this at the present value. The discounting factor is given as 10%. So what I have to do is 10 lakhs, obviously I have to give 10 lakh rupees plus 2 lakh 4,000 and 904. That is nothing but the present value of the dismantling or the decommissioning cost. The total asset value will be 12 lakh 4,000. Now please tell me, did you pay this 10 lakh? The answer is yes. But have you paid this 2 lakh 4,000? The answer is no. You haven't paid this 2 lakh 4,000. You have to pay 3 lakh after 4 years. That means what you have to do, you have to unwind. That is unwinding of the interest. What you have to do is, you have to unwind the interest. What exactly do I mean? First point, if you have to record the asset, what is the journal entry to record the asset? It is nothing but PPE to bank, right? PPE to bank. Now I'm asking you, what amount did you pay? You will say 10 lakhs. I paid 10 lakhs, right? But you told me that the cost of the asset should be 12 lakh 4,000. It should be 12 lakh 4,904. But you have paid only 10 lakhs. Can I say the rest amount is nothing but a provision which you created right now? Yes. So the cost of the asset is 12 lakh 4,000, but 2 lakh 4,904 is the provision. So you have to write provision for decommissioning. You have to write provision for decommissioning. This should be in your balance sheet. Now, what you have to do of this provision? You just have to unwind. What is unwinding? I'll tell you. You have to say opening, interest, and closing. That's it. Interest at what rate? At the rate 10%. The opening was 204,904. At the end of first year, what you have to do is you have to charge interest. You have to charge interest at the rate 10%. It will come to 204,900. Then what? It is nothing but opening plus interest. Opening plus interest. You just have to add it. You just have to add it. Whatever the added cost is becomes opening for the next year. Again, on next year, 10% interest and so on. It will go on till 4 years. And at the end of 4 years, year 1, year 2, year 3, year 4, this amount you will get as 3 lakh rupees. This amount you will get as 3 lakh rupees. This is known as unwinding of interest, unwinding process, right? So what is the journal entry for this? The journal entry will be interest account debit and to provision. Interest is nothing but the finance charge. To provision, you are adding up the provision so that the provision gets added and added and added and comes to 3 lakh after 4 years. Okay, what after 4 years? Do you have to pay that 3 lakh rupees for restoration? The answer is yes. Just pay it. So what is the entry for payment? It is nothing but provision to bank. Just pay 3 lakh rupees and you are done. At the end of 4 years, what you have to do is you just have to pay 3 lakh rupees. So I've given the entire table. You can have a look. The first entry on 1419 will be nothing but to record the asset to bank, that is PPE to bank, and also I created a provision for decommissioning. What you have to do is you just have to take opening, interest, closing. Closing is nothing but opening plus interest. The closing becomes opening for the next year. Again 10% interest, add it, again 10% interest and add it. In the last year, you have to take the balancing figure. Why balancing figure? Because you have to take the total of 3 lakh rupees. You have to take the total of 3 lakh rupees. So what are the journal entries for all the 4 years? It is nothing but interest to provision. You are just adding up the provision each and every time. So these are the entries: interest to provision, interest to provision, interest to provision, interest to provision for all the 4 years. And at the end of 4th years, the provision amount will be 3 lakh rupees. So you just have to pay 3 lakh rupees and the entry will be provision to bank, and that's it. You are done with that, right? So what you have to do is, if I say what was included, if I say initial measurement, we have 4 things. First is the purchase one. What if I purchase? And what if I construct by self-constructed? Self-constructed, right? Only one thing is different between these two. I'll tell you what. First of all, what to include in purchases? Give me the list of purchases. What to include? So I can include purchase price, obviously minus TD, right? Minus TD. All the non-refundable taxes. All the non-refundable taxes, right? Next point. All the directly attributable expenses. Directly attributable expenses. Then what if the testing cost? The testing cost minus the testing income, less testing income. Even if it is negative, let it be here only. Don't transfer it to P&L. Okay, testing income. Okay, fine. And provision for decommissioning. Provision for decommissioning. But at what value? At present value. And each year what you have to do is you just have to unwind. What is unwinding? It is nothing but interest, add closing. Then again closing becomes opening and then interest. The journal entry is very simple. It is nothing but interest to provision. Okay, fine. Okay. What to exclude? What to exclude? Any inauguration. Any inauguration, advertisement or promotion. The training cost. Refundable taxes. Refundable taxes. It should not be added. Okay. Then we have cash discount. It should not be included in over here, right? And the important one was temporary income. Temporary income. It should be transferred to P&L. And also abnormal losses. For example, if I say I'm using a material for construction for, let's say, 1 lakh rupees. 5,000 was wastage. 5,000 got wasted. So I'll not add 5,000 to it. I'll not add 5,000 to the cost of asset. 5,000 will be transferred to P&L because it is nothing but the abnormal loss, right? Okay. So we have to exclude this, right? I hope this point are clear. What is the difference between purchase and self-constructed? I'm adding up the building. What are the expenses to be included? The same thing. Every expense, all the expenses like this. But one more thing will be added. One important thing. It is nothing but interest will be capitalized. Interest will be capitalized. As per IND AS 23, that is the borrowing cost. Obviously, if it is qualifying asset, if you know this point, it is very good. If not, then I'll be taking IND AS 23 also. That at that time I'll be explaining to you. Interest is never added to the cost only if it is a qualifying asset. If qualifying asset, then only it will be added, or else it will not be added, right? That is, if you take a loan, and if you are paying interest on it, it will be added to the cost of the asset only if it is a qualifying asset. Now, what is qualifying asset? And I'll take in detail in IND AS 23. Okay, fine. Okay. So what to include and what to exclude, we have already taken. The third important point is exchange. The third important point is exchange. Now, what is exchange? I'll tell you. Exchange is nothing but a barter system, giving one asset and taking one asset. Give an asset and take one asset, right? For example, if this is the balance sheet and I'm having over here machinery for rupees, let's say 4,000. Now, this 4,000 is known as the book value or the carrying amount. Book value or the carrying amount. Like, I'm giving this asset, I'm taking another asset. So, यहाँ पे to machinery will be the outgoing asset and it will always be at the carrying amount. Always at the carrying amount. That is 4,000. Okay, it went out. Now, the question is, at what value will I record the incoming asset? I have given the machinery, but let's say I have taken furniture. So now the question is not of machinery. The question is, at what value should I record the furniture in my books? This is known as exchange. If I'm exchanging an asset for an asset, at what value should I record? So basically, there are three rules to it. In if you check the Bear Act, at that time it will not be given three rules. There are only two rules, but I have given into three rules. What are those 3 points? I'll discuss with you. Yeah. So these are the three rules. Exchange of asset. At what value to record the acquired asset? I'm talking about the furniture, not the machinery. Okay, machinery will go out from my books at 4,000 itself, right? Okay, so these are the preferences given by the institute which you have to follow. What is the first preference? The first preference is value of asset given up plus cash paid, if any. For example, if I say this is the balance sheet, this is the machinery 4,000, right? So machinery is going out and furniture is coming in. So first of all, give a journal entry for incoming and outgoing asset. Debit word comes in and credit word goes out. What will I record? I'll record furniture account debit to machinery. Machinery will always go out from my books at 4,000. Now, what is the first point? The first point is, at what value to record the furniture? You should record the furniture at the fair value of asset given up. Which asset you are giving up? It is the machinery you are giving up, right? So you have to record the first preference, fair value, that is the market value of the asset given up. For example, let's say the fair value of this machinery was given to be 5,200. So you have to record the furniture at 5,200 and not at 4,000 okay. Okay, fine. Two, the difference will go to P&L. That is 1,200. So the first point is, the first preference, if fair value of asset given up is there, then you should record at the fair value of asset given up. Okay, fine. What if this was not there? Take the second preference then record at the fair value of asset acquired. Let's say the fair value was 4,500. If you don't have the fair value of asset given up, then the second preference goes to the fair value of asset acquired. Whatever you are acquiring, take that fair value. Okay, so at that time I'll record it at 4,500, so the profit becomes 500. So the profit becomes 500, right? What if this is also not there? That means you don't have any of the fair value. At that time, the third preference is record the incoming asset at the cost, at the book value of the asset given up. Book value of the asset given up was 4,000, so I'll record at 4,000 itself. That's it. These are the three preferences. I hope everyone is getting this point. I'll repeat the three procedures again. First preference. What is the first preference? It is nothing but the fair value of asset given up. Second preference, the fair value of asset acquired. And third, if both are not there, then go with the third preference, that is carrying amount of the asset acquired, asset given up. जो मैं asset give up कर रहा हूँ, whichever asset I am giving up, record at that carrying amount itself. Okay, these are the 3 points. I'll give you another example. So I've given the example, please pay attention. Mr. A, asset acquired was laptop and the asset given up was iPhone. Acquiring laptop, giving is iPhone. So debit word comes in laptop account, debit to iPhone account. This is the entry, right? The three values are given. Two fair values and one is the carrying amount. Obviously, first of all, what you have to do is take the entry of debit word comes in and credit word goes out. So it will be laptop account debit to iPhone account. iPhone will go out from my books always at the carrying amount because I'm carrying it at 60,000. I will make it 0 and therefore it has to be 60,000 always. Now the question is not about the outgoing asset. It is about the incoming asset, that is laptop. What I have to record? The first preference, the fair value of asset given up. What is the fair value of asset given up? It is 80,000. So I'll record at 80,000 and whatever the difference is, I'll transfer to P&L as the gain. That is, I'm giving up 60 and I'm taking 80, like that. Okay, so I'll record the laptop at 80,000 by booking a gain of 20,000. Okay, second amount. What if this was not there? What if this was not there? The second preference says fair value of asset acquired. If you're not having the fair value, your fair value, then take the fair value of the asset which you are acquiring. So the second preference goes to asset acquired. So I'll record it 1,10,000, giving me a gain of 50,000. Giving me a gain of 50,000. Okay. The third point. What if this was also not there? I don't have any of the fair value. Then the third preference is carrying amount of the asset given up. Whatever you are giving up, recorded that cost only. That means 60,000 was the value of iPhone and 60,000 itself becomes the value of laptop. No profit, no loss in this situation. I hope the point is clear. Yes, everyone please tell me, यहाँ तक सबको समझ में आ रहा है क्या? Is the point clear till here? And if you have any query till here, please ask. Yes, if you have any query, please let me know. Okay, moving ahead. Now, so I gave you the three preferences, right? I'll again repeat the preferences for you. Fair value of asset given up, fair value of asset acquired, or the third preference, carrying amount. Now, there is also one more point over here, which is lacking of the commercial substance. Now, what do you mean by lacks commercial substance? If I acquire the same asset by giving up the same asset, for example, I'm giving up this black iPhone in exchange of white iPhone. So this is iPhone to iPhone, right? In that scenario, these two preferences are not given. We have to follow the third preference. That is, I should record the acquired asset at the carrying amount of asset given up itself. I will not have only the first two options. It is only the third preference if at all it lacks commercial substance. For example, I've given the example over here. See, asset acquired, iPhone white. Asset given up, iPhone black. Both the fair values are given and also the carrying amount is given. I'll say the fair values are of no use to me because it lacks commercial substance. It is iPhone to iPhone. It lacks commercial substance. When the exchange is of the such nature that it is the same asset is acquired by giving up the same asset, at that time it will you will not record any profit or loss. You just have to record at the carrying amount. So the entry will be iPhone to iPhone, that is white to black, 60 itself, and no profit booking will be possible. Okay, so these are the exchange points. So coming to the chart, yeah, so it was exchange. I gave you the three preferences. What were the preferences? The first preference was fair value of asset given up. The second was fair value of asset acquired. And the third one was carrying amount of asset given up. So if you have those, record at that value. If you don't have, then go for the second or the third preference. Okay. So these are the three preferences. Okay. And if it lacks commercial substance, then in that scenario, you just have only one option, and that is the third option. That is the carrying amount of asset given up, right? Okay. There was also fourth point involved in this. The fourth point was government grant, that is through grant. So this is covered in IND AS 20, government grant. Okay, so you don't have to take it over here, it will be covered under IND AS 20, how to record that asset and at what value. Okay, fine. So I have given you up till now only 3 points. What are the 3 points? The first is definition, second is recognition, the third is initial measurement. I haven't started with the subsequent measurement yet. It is only initial measurement. 4 points. What are the 4 points? I can purchase it, I can self-construct it, I can take the asset by an exchange, and I can get an asset through a government grant, right? Okay, what to include and what to exclude, I have already explained in detail, right? So moving ahead, what about the subsequent? Okay, 1 point is remaining over here, and that is the deferred one. Just 1 minute. Yeah, over here, the deferred consideration. What do you mean by deferred consideration? What do you mean by deferred consideration? It is nothing but the interest cost. I'll ask you a question, everyone has to answer. Okay, let's say I want to take a laptop. The laptop, I went to, let's say, Chroma, and I purchased a laptop for let's say rupees 1 lakh, but I was not having 1 lakh with me. I told Chroma that give me some credit. So they told that okay, what you do is give us 25,000 or else 23,000 5 years, for 5 years, that is 1,15,000. 1,15,000. Can you please tell me at what value should I record the asset? I have given 23,000 only right now, and they told you have to pay 23, 23, 23, 23, 23 for 5 years, and total of 1,15,000 I have to pay for the laptop. So at what value should I record? I'm paying only 23,000, so should I record the laptop right now at 23,000? Should I record it 1,15,000, or should I record it 1 lakh, or if you have any other value, please tell me. Everyone has to answer this. At what value should I record this? At what value should I record this? Please tell me. Yes, please tell me at what value should I record this? I need an amount. Yes, everyone, please be active and give an answers quickly. Okay. Yes, Lokesh, Haripriya, yes, perfect. I should record the asset at 1 lakh only. That is, this 15,000, is known as the deferred consideration. Basically, it is as good as I'm taking a loan and I'm repaying it with interest, right? So this 15,000 will not be added to the laptop cost. This is nothing but to be expensed as and when paid. This is nothing but it should be transferred to P&L. Okay, so deferred consideration will not be added to the cost. So I'll just write over there deferred consideration, that is interest. Deferred consideration, that is interest, should not be added. This is interest. Okay, so these are the basic points to be covered. Next, the next point is subsequent recognition. Subsequent. Now, what do you mean by subsequent? Subsequent means every balance sheet date. For example, let's say you have purchased it on 1/4/21. You have purchased at, let's say, 10 lakh rupees, and the life is 10 years. So on 31st March 22, you will depreciate, let's say, 1 lakh. So what is the WDV? The WDV comes to 9 lakh rupees. So cost model says record at 9 lakh itself, because the value is 9 lakh rupees right now, right? So cost less accumulated depreciation till date. But revaluation says, you should take the fair value. You should also check the fair value right now. Let's say the fair value comes to 12 lakh. That is increase in the value. So can you record this gain? The answer is yes, you can record. Ind AS 16 permits this, that you can book a gain. Okay, so I book a gain of 3 lakh rupees. So the value comes to 12 lakhs. So the value comes to 12 lakhs. So this gain, the entry will be, obviously I'm increasing the asset. So asset account debit, there is PP to revaluation surplus. But if it is downward, it will go directly to P&L. If you are making a downward revaluation, for example, let's say if it is not 12 lakh, it comes to 7 lakh. The value drops to 7 lakh. At that time, you will subtract 2 lakhs from it. And if you are reducing the value, asset as debit balance, to reduce it, you will make a credit to PPE 2 lakhs. And this 2 lakh will be transferred to P&L and not to revaluation surplus. This is the point, revaluation model. Okay, so there are two methods. Subsequent measurement can be measured on two bases. First is cost and the second is revaluation. Okay, now for revaluation there are a lot of points. I'll discuss it one by one. The first point says frequency of revaluation. When you should revalue? So it says if the change is very significant and volatile, at least annually once you have to check. On, let's say, 31st March every year you need to check. If the frequency, if the the change is very volatile, at that time you have to check annually. But if this changes is insignificant, very rare amount, let's say 9 lakh and 9 lakh 10,000 or 9 lakh 5,000, then at that time you can check in 3 to 5 years. Not very important, but yes, the frequency, how to check, when to check, right? The second, treatment of accumulated depreciation. This one is important. Treatment of accumulated depreciation. I'll give an example over here. What is the treatment of accumulated depreciation? If you revalue, now what they are talking about, I've given, I've explained with an example. So please pay attention. This one is very important. This is one of the important question. Okay. So treatment of accumulated depreciation. I've given an example. Please pay attention. The cost is 10,000. Life is 10 years, and accumulated depreciation is 4,000. Let's say it has been depreciated for 4 years. So what is the WDV right now? 6,000. Now after depreciating it for 4 years, the fair value after 4 years comes to 7,500. Can I increase the value? The answer is yes. You can increase the value. Increase the value by what amount? It is 7,500. Sorry, 1,500. That is, you should increase by 1,500. So obviously you will get a gain. Now I'm not talking about this. I'm talking about this 4,000. What to do of this 4,000? What to do of the accumulated depreciation in case of revaluation? What should we do? So we have two methods. You can follow any of the method. You have two options with you. You can follow any of the method, whatever you like. Okay. But institute asks you both the methods. Give the answer by both the methods, right? So what are the two methods we have? The first method is reverse this depreciation. That is, close this account. Close this provision. Now please tell me, accumulated depreciation is a provision. It has which balance? The answer is credit balance. So what you do is make it a debit. Close it. Okay, I'll close it. So accumulated depreciation account debit. 2. Reduce the value of PPE to PPE. So the first point is 4,000 gets reversed and the value of the asset also gets reversed. That means the value of the asset now becomes 6,000, because initially I recorded 10,000 and now I decreased by 4,000. That means the value of the asset becomes 6,000 right now. And now at the value 1500, second entry will be PPE account debit to revaluation surplus as discussed right now. Revaluation surplus 1500. You will add up 1500 to the cost of asset. That means the cost will now be 7,500. Balance sheet will be something like this. If this is the balance sheet, PPE will be 6,000. Why 6,000? Because it was 10,000 minus the accumulated depreciation. What do you do is you reverse the depreciation. Okay, 6,000. Add back revaluation for 1,500. The value will be 7,500. And in the other equity part, you will see revaluation surplus over here of 1,500. This is one presentation, which is very easy, right? So what are the two steps? Reverse the depreciation, that is close the depreciation. How to close? Accumulated depreciation as credit balance. Close करने के लिए we need to debit. Asset will be reduced. So asset has a debit balance. To reduce, make it a credit. So first entry is clear. Second, make the journal entry for the revaluation surplus. Revaluation surplus, obviously it is increasing the asset, increase the cost of the asset, that means to debit PPE and to credit revaluation surplus. This is easy. This was first method. Second method says add everything by same proportion. Now what is add everything by same proportion? I'll give an example over here itself. First is, second option is do not eliminate, increase everything by same percentage. Now what is increase? So first of all, you are having a gross block of 10,000. 4,000 was the accumulated depreciation and the net block was 6,000. This was the picture given to you, right? This was the picture given to you. Now what you are doing is you have increased it to 7,500. That means you have increasing by 1,500. 1500 आपने बढ़ा दिया. You have increased by 1,500. 1,500 is what percentage of 6,000? It comes to 25%. It comes to 25%. Now what the institute is saying is, what you do is you add up this by 25% and you add up this provision also by 25%. You do not eliminate the accumulated depreciation. What you do is you add everything by the same proportion. If you are increasing by 25%, add up the gross block by 25% and add the accumulated depreciation also by 25%. Now what this will do? I'll give an example with the journal entry. You are increasing the value of asset by 25%. So by what value are you increasing? It is increasing by 2,500. So PPE should be debited by 2,500. 2. Accumulated depreciation. You should also increase the depreciation by 25%. So 25% comes to 1,000. And 2 revaluation surplus. It will come to 1,500, which was the desired answer. You need to increase the revaluation surplus by 1,500, right? So this is the second point. So there are basically 2 points which are very important. What are the 2 points? The first point is eliminate, that is close the accumulated depreciation account and then revalue. Close the depreciation, accumulated depreciation and then revalue. Second is do not eliminate. What you do is you increase everything by the same percentage. These are the 2 points. So before proceeding ahead, we'll solve a question on this and then we'll move ahead to the next question. Yeah. So treatment of accumulated depreciation. The question is in front of you. I'll be reading the question. I'll be giving you 2 to 3 minutes to solve and then we'll discuss the same. Okay. Company X performed a revaluation of all of its plant and machinery at the beginning of 21. The following information relates to one of the machineries. The gross amount is 200. The accumulated depreciation till date is 80 and the net value is 120. What you're doing is you're revaluing 120 to 150. That means you want to increase by 30. First point. Okay. The useful life of the machinery is 10 years and the company uses straight line method. The revaluation was performed at the end of 4 years. You can clearly see if 10 years is the life, per year depreciation comes to 20. 4 years it comes to 80. That means you have already depreciated for 4 years and after 4 years you are revaluing it. Advise how the company should account for revaluation of plant and machinery and depreciation subsequent to revaluation. Support your answer with journal entries. Please give me the 2 journal entries. If I go with the first method, I need the 2 journal entries if I go by first method, and then if I go by second method, what is the single entry with the amount? Okay, I want only one entry with the amount, second entry. Yes, I'm giving you 2 to 3 minutes. It is very easy yet important. Accumulated depreciation to PPE 80. Okay, perfect. Percentage. And PP to revaluation 30. Perfect. Perfect. So these are the two entries. The first entry is eliminate the depreciation. Eliminate the accumulated depreciation. Right? How to eliminate? It is very simple. Accumulated depreciation to PPE 80 and 80. Right? And second is now revalue. Revalue upward. Revalue upward. So how to revalue upward? It is very simple. Increase the value of the asset, that is PPE account debit, to revaluation surplus. To revaluation surplus. How much is the surplus? 30. This is the first method. Okay. Can anyone give me the second method now? Second method. This was the first method. Okay. And you have an option. It is or second method. Second method says don't eliminate. Second method says don't eliminate. So what do you have to do? You have to increase everything in the same proportion. You have to increase everything in the same proportion. I'll explain again. See, the cost was 200. The depreciation was 80. Right? The accumulated depreciation. I'll be more specific. Less accumulated depreciation. Right? So what was the net block WDV? The WDV came to 120, and now you are increasing it to 130. Sorry, 150. You are increasing it to 150. So what is the increase? The increase is rupees 30, right? 30 is what percentage? 30 is what percentage of 120? It comes to 25%. That is, increase is 25%. So what you have to do is, you just have to increase everything by 25%. Yeah, you have to increase everything by 25%. So what you have to do is plus 25% and plus 25% everything. So if you add 25%, you will get the answer as 250. If you add 25%, you get the answer as 100, and if you check, it will get matched. So what you have to do is, you have to increase the cost, and you also have to increase the depreciation. So how to increase the cost? Obviously by debiting PP. 2, I need to increase the depreciation also, and 2, revaluation surplus. So it was 50, 20 and 30. You have increased the cost by 50, you have increased the depreciation by 20, and you have increased the revaluation surplus by 30. These are the answers. Yes, perfect answers. Yes. So I hope you are getting this point. So these are the two methods, first method and the second method, that is what to do of the accumulated depreciation in case of revaluation. Okay, I hope this point is clear now. Okay, moving ahead. This was the accumulated depreciation. Okay, coming to the third point. See, we were over here, revaluation model. This is important. Third point, revaluation to be applied to entire class of asset. Now what do we mean to be entire class of asset? See, if you are applying cost model for building, you can go with. If you are applying revaluation model for machinery, you can go with it. But if you will say, sir, I have two machineries with me, I want to apply cost model to it and revaluation model to the second one. The answer is no, you cannot do it. It should be applied to the entire class. If it is one machinery, every machinery should follow cost, or every machinery should follow revaluation. You cannot do one cost and one revaluation. Every machinery should be doing. But the point is, if you have two buildings, one is the office building and the next is factory building, these can be treated as two separate class of asset. That is, factory building and office building, these are two separate things. These are two separate class of asset because the use is separate, right? Factory will obviously use machineries over there, and office will only use furniture and employees over there, right? So these are two different class. You can follow cost and revaluation to each of them, right? You can follow. So the revaluation model is to be applied to the entire class. Next, treatment of revaluation gain or loss. Again, this is one of the important point. Treatment of revaluation gain or loss. Please pay attention. I have already given the chart. Yeah. Now, if it is the first time, if the gain is first time, that is, you are revaluing it for the first time, at that time, the gain should be transferred to OCI, and I have written over there NR. Now, what is NR? It is not reclassified to P&L again. OCI R means it should be classified to P&L. NR means it should not be reclassified. I'll give an example after this, okay? If it is a loss, directly transfer to P&L. So basically, I'm telling that if it is a gain, the entry should be PPE to revaluation surplus, and this revaluation surplus should go to OCI. OCI what? NR. That is not reclassified to P&L. Okay. And if there is a loss, it should directly go to P&L. P&L to PPE. I'm talking about this, right? Now, when to do this? If it is the first time. But if again in the next year you are again making a revaluation, and again at that time if you are getting a gain or loss, that is important. That is important. For example, let's say you purchase the asset for 1,000. You depreciated it for 10,000, and depreciation is 1,000. The value comes to 9,000. Now you took the revaluation model and you got it revalued to, let's say, up by 4,500. So the value comes to 13,500. This was revaluation. Okay, this was revaluation. Now obviously you will depreciate 13,500 by 9 years and so on. Okay, in that scenario, this revaluation surplus should go to OCI. Fine. Okay, but after depreciating for like 2 more years, let's say 1,500 was 1 year depreciation, 1,500 was second year depreciation, right? Your value comes to 10,500. Now in the second year or else in the next year, the value drops to 6,000. The value drops to 6,000. That means, can I say the loss is 4,000? Okay, I'll make it 7,000. So the value comes to 3,500, right? You need to reduce the value by 3,500, and this will be 7,000. Now, should you go to P&L? The answer is no. You should not go to P&L directly. Although I know it is a loss. Loss should go to P&L. But do you have any OCI balance revalued for this asset? The answer is yes. If you have the OCI balance, use that balance first. Use that balance first and then transfer it to the P&L. For example, if 3,500 is there, is it sufficient to be covered from OCI? The answer is yes. That means the loss should be transferred to OCI, not to P&L. But what if the value drops to 5,000? That means you have to depreciate it by 5,500. You have to revalue downward by 5,500. Now, will you go to P&L directly? The answer is no. Do you have OCI balance? The answer is yes. OCI is how much? 4,500. The balance 1,000 should go to P&L. The balance 1,000 should go to P&L. So what should be the entry over here? What should be the entry over here? You are reducing PPE, right? So PPE should be created. You cannot go to P&L directly. No. You have to use the OCI balance. If you have a gain previously but now lost, then use that gain first and then to the P&L. So OCI will be debited at 4,500, but the total loss was 5,500. So the balance loss should be transferred to P&L. It is like this, right? So I hope this point is clear. So I have given the entire chart. Please check. If there was a gain, then it was OCI. True. But if previously it was a loss, then and now it is a gain, then transfer the loss first to P&L and then the gain to OCI. That is the reverse case of what I taught right now. Okay. So I've given the examples. Please check. Okay. So previously there was a gain of 70. Let's say 2 years ago I revalued it and the gain was 70. I transferred it to OCI. True. Okay. Fine. Done. This is easy. In the subsequent year, there was again a gain. I will again transfer it to OCI then. It is very simple. Both were gains, right? Just 1 minute. Both were gains, so I should transfer to OCI. Okay. Previous it was gain of 80. Previously, in the previous or 2 or 3 years ago, I revalued it and there was a loss of 80. So I transferred it to P&L. But subsequently there was a gain. I cannot transfer it to OCI because up till 80 I will go to P&L only. That is, initially there was a loss of 80 and now you are getting a gain. And now you are getting a gain. So I will not directly go to the OCI. First go to P&L till the loss bed. That is 80 was the loss bed with P&L. So I'll transfer 60 not to OCI but to P&L. This was the point. Okay. Next. If there was a loss of 90 in the previous years, loss previously 90. Okay. But subsequently you are getting a gain. You cannot transfer directly to OCI. You have to give 90 to P&L first because there was a loss previously, right? So give 90 to P&L first and then transfer the balance to OCI. This is the point, right? Okay. Next one. First is loss, another is also loss, both P&L directly. But previously there was a gain. Obviously you transferred to OCI. But now you are getting a 60 loss. So you cannot go to P&L. Obviously bear this 60 to OCI itself. Next point. If you are getting a gain of 60, so obviously you booked it on OCI. But after that you are getting loss. So you cannot book the loss to P&L directly. What you have to do is you have to give the loss till 60 up to OCI and next to P&L. This is the point, right? I hope you got this point of the treatment of revaluation gain. Treatment of revaluation gain. That is, if in the future years you are getting a gain or a loss, don't directly transfer. Check whether there was a gain or loss in the previous years. If yes, then reverse that gain or loss and then move ahead with the regular steps. Okay. This is the revaluation treatment. Okay, fine. Next point. Probably the last important point. इसके बाद जो भी है ना, वो सब छोड़े, very small points are there left, but probably this is the last important point. Okay. After this, we'll be solving the questions. E point. Transfer of balance and revaluation surplus to retained earning. If you have a revaluation surplus, then will you transfer it to retained earning RE? Retained earning RE. So basically there are 2 points. This I'll be talking about later. When the PP is disposed or de-recognized, that means if you are selling the asset, then transfer the entire balance to RE. Example, what they are telling, see, this is P&L and this is OCI, other comprehensive income. It is as well as P&L. Okay, I'm making a T because this is the easy format. Okay, so initially if you have a balance sheet over here, there is other equity over here. Okay, there is other equity over here and there is revaluation surplus and RE, retained earning, right? So what they are telling is, if you have a revaluation surplus of let's say 5,000 rupees on an asset and now you sold the asset, over here there was PP on which there was revaluation, but you sold the asset now. So if there is no asset left, what will you do of the revaluation reserve now? So what they are telling is, just transfer it to PPE, that is RE. Just transfer this 5,000 to RE. That is if you are disposing it off. Transfer the entire balance to retained earnings. You don't have to reclassify to P&L. You cannot transfer it to P&L and then to retained earnings. No, you have to directly transfer because it is OCI NR. What is NR? Not reclassified. One point is there where there is R, but for India 16 there is not R, it is NR. NR is not reclassified. Okay, so this is mandatory. You have to do this. But the important point is over here, excess depreciation. What is excess depreciation? I'll explain you with an example. Okay, let's say I purchase an asset for 10,000 with a life of 10 years. Okay, with the life of 10 years. First year there was a depreciation of 1,000. The value came to 9,000. Again the second year debt was 1,000, making an SLM. The value dropped to 8,000. Obviously this is the WDV. This is the WDV, right? Now what I'm telling is, now I revalued, the fair value over here was 12,000. How much was the fair value? It came to 12,000. So do I have the option to follow revaluation model? The answer is yes. You can revalue, right? So I followed the revaluation model and I went up 4,000, add revaluation surplus. Oh, okay. So what will be the journal entry for this? Obviously you will say, sir, you are adding the PP. So add up the PP cost and transfer this to revaluation surplus. Revaluation surplus. Okay. By making the transfer to OCI. Fine. 4,000. Now what is the value? 12,000. And now, what is the remaining life? The remaining life is 8 years, right? The remaining life is 8 years because 2 years you have already depreciated. Can you tell me what is the third year depreciation? Obviously, you will say now it will be 12,000 minus the scrap 0, and the remaining life is 8 years. So the depreciation comes to 1500. The depreciation comes to 1500. So what is the value now? Obviously 10,500. So this is very simple. This is re-estimation or revaluation. This is very simple. But the important point is here, over here is, initially you are making a depreciation of 1000, but now you are making a depreciation of 1500. Can I say there is excess depreciation of 500? That means you are charging expense more. Obviously, P&L will say that you are charging depreciation more by 500 because of your evaluation. Right? Because of your evaluation, you are charging excess depreciation, and therefore the profit is lower. So you have an option, not mandatory. You have an option. What you can do is, in your balance sheet, this is other equity. Okay, this is other equity. This is RE and this is revaluation surplus. Revaluation surplus was 4,000, right? What you can do is, you can transfer 500, that is the excess depreciation, to RE if you opt for this. It is a choice of yours. आपको अगर चाहिए तो आप कर सकते हो, नहीं तो you can ignore. That is, it is an option whether to transfer the excess depreciation to retained earnings, right? It is just an option, not mandatory. It is just an option whether you have to transfer that 500 to retained earning or not. That is the excess depreciation. This is not mandatory. I'm again telling you, this is not mandatory. This was just optional. Okay, this was just optional. Right. So what we have covered till now, measurement, subsequent. The subsequent measurement can be at cost itself, or you can follow the revaluation model, right? At cost, you have to do nothing then, or at revaluation model, or at revaluation model. If you are following the revaluation, I'm not extending all the 5 points. Only three important points are there. 3 important points. First is, what will you do of the accumulated depreciation? What will you do of the accumulated depreciation? So you have two methods for it. You have two methods for it. What are the two methods? What were the two methods? The two methods first point is eliminate accumulated depreciation and then revalue. And the second point is, don't eliminate, but increase everything by the same proportion. But increase everything by same proportion, or else same percentage. These are the two methods, right? Okay. Then, what about the gain or loss in subsequent years? In subsequent years, obviously the gain goes to OCI, the loss goes to P&L. But if the gain is in the subsequent years, then check the previous gain. Check previous gain or loss, and give the treatment. For example, if again I'm telling you, if there was revaluation gain of 1000, and now I'm getting loss of 800, so I will not go to P&L directly. I will go to OCI because I was already having a gain with me 1000. But if the loss exceeds my gain, if I was having a gain of 1000, but now the loss is 1500, so I will take that loss to OCI 1000 and 500 will go to P&L, like this, right? Always check the previous year gain. And the third point was excess depreciation. The third point was excess depreciation. You have an option. It is not mandatory, okay? This is option. Option to transfer the amount of excess depreciation, the amount of excess depreciation to RE, that is retained earnings, from revaluation surplus, from revaluation surplus, right? Okay. And what if, what will you do of the revaluation surplus when you sell it off? If the asset is sold, I'll give you the fourth point over here. Okay. If asset is derecognized, that is sold, derecognized, then what you have to do? Then transfer the entire balance which you have in revaluation surplus to RE. Transfer entire balance of revaluation surplus to RE. To RE. Okay, that is retained earnings. These are the four important points. I hope every point till here is clear, right? So I gave you the information from here. We have covered definition. We have covered recognition criteria, that is when to record. Then measurement is at what value to record. Measurement on the first date always at cost, and on the subsequent it can follow cost model or revaluation model. If it was initial measurement, obviously you can purchase it, you can construct it, you can get it in exchange, or you can get it as a government grant. Then what to do of this next years on every 31st March? You can follow the cost model or the revaluation model. 2 points I haven't written over here is the frequency when to check the revaluation and the class of asset. Class of asset, I told you already, if you're following the cost model, you have to make the cost model for the entire class. You cannot say machinery one class will be cost and one class will be revaluation, right? But office building, industrial building are two separate things. Okay. Then accumulated depreciation, you are having two methods. First is eliminate, and the second is don't eliminate. Next, gain or loss, obviously if it is in the next or subsequent years, always check the previous years whether there was a gain or a loss in the previous year. If it is excess depreciation, you have an option whether to transfer the excess depreciation, the amount of excess depreciation from revaluation surplus to retained earnings. And if you sell the asset or de-recognize the asset, you don't have to keep the balance of revaluation surplus in revaluation surplus, you just have to transfer to retained earnings. These are the points which you have to follow, right? I hope this point is clear till here. Next. Yeah, we are done. We are done. Okay. Yeah, this was the excess depreciation example. So I've just given an excess depreciation. You can just follow this point also. Okay. Next, what about the subsequent cost? These are some of the small points. Okay, just give me 1 minute. Yeah. So subsequent cost. What do you mean by subsequent cost? Obviously, there will be future maintenance cost also for the machinery or for the anything, right? So subsequent cost, if it is a repair cost, regular repair cost, at that time transfer to P&L. Obviously repairs goes to P&L, not to the cost of asset, right? But if you are replacing, or if it is a major inspection cost, at that time what you have to do is you have to de-recognize the old part and recognize the new part. What do you mean by this? So it is very simple. See, if I say this is a balance sheet and I purchase machinery for, let's say, 1 lakh rupees. Let's say 1 lakh rupees, right? Okay. Now what I'm telling is, this machinery, there are two components in it. Two components. What are two components? The first is, let's say this is a machinery which I purchased for 10,000, sorry, 1 lakh, but there was also an engine. I did not pay extra for engine. Obviously that was there in the machinery itself. The cost of the engine was 20,000, which was that at that time. So I paid actually 1 lakh rupees. Now what is inspection or the replacement cost? See, if the life is, let's say, 5 years and the life is, let's say, 10 years. So over here I can say this is component accounting. What is component? That is, you have two components in the same thing. So what you have to do is you have to separate it, like engine and the other parts. Purchase, let's say purchase value was 20,000 and the purchase value was 80,000 for the rest of the machinery, right? What will you depreciate in the first year? Obviously it is the life is 4 years, sorry 5 years. So 20,000 divided by 5, the depreciation of the first year will come to 4,000. Okay, but the life is 10 years over here, so I'll depreciate by divided by 10,000, sorry 8,000. The value drops to 16 and 72. Okay, second year depreciation, obviously following SLM 4,000 and 8,000, the value comes to 12,000 and 64,000. Again for the third year I again depreciated it for 4,000 and 8,000. The value comes to 8,000 and 56,000. Okay, 56,000. 3 years I depreciated. After 3 years, I replaced the engine. This is WDV after 3 years. Okay, I replaced the engine for rupees, let's say 14,000, or I'll say 25,000. So what I have to do? It is very simple. As of now, my total cost was, total WDV was 64,000, right? 56 plus 8. What I'll do is I'll remove, de-recognize the old part, that is remove from the books the old part 8,000 and recognize the new part. Simple. Recognize the new part was 25,000, and now I will say the value comes to 81,000. 817, yeah, 81,000. Now my asset will be 81,000. Now what is this saying? De-recognize the old part, that is remove from the books. Obviously I cannot remove at 20,000, right? I cannot remove at 20,000 because I don't have the cost of 20,000. I used it, I depreciated it, and the value was 8,000 right now. So I'll remove from my books at 8,000 and I'll recognize the new asset at 25,000. Simple as that. So if there is replacement or major inspection cost, at that time you treat it as there was not one asset, there was two assets. There were two assets, right? There were two assets, and what you have to do is you have to de-recognize one of the asset, the old part, and you have to recognize the new part. It is that simple. Okay, so this are the points. This also gets covered the component accounting. Subsequent cost also, the next part is component accounting over here. Component, right? Okay. Now the next point is depreciation. What is depreciation? When will you start depreciating? First of all, land is a non-depreciable asset. You cannot depreciate land. It is a building which is depreciated. Okay. Okay. Ready to use. That means if you are purchasing, okay, I'll give you an example over here. I'll write a lot of dates over here. Just tell me when to start the depreciation. So on 1/4/2021, I ordered a machinery. On 1/5/21, I paid the advance. On 1/6/21, the machinery got dispatched. On 1/7/21, received the machinery. Okay. On 1/8/21, the machinery got installed. On 1/9/21, I started using, and on 1/10/21, I paid the entire balance, paid the balance amount. So there are a lot of dates now from 1/4 to 1/10. Please tell me, from where should I start depreciation? From where should I start with the depreciation? Please tell me. When should I start with the depreciation? Yes, from where should I start with the depreciation? I've ordered, advanced, dispatched, received, installed, started using, paid the balance, everything. 1/8. Okay, Shivam, that is the correct answer. That is when it is ready to use, not when you have started using. When it is ready to use, जब वो ready हो जाएगा तब आपने depreciation start करना है. Okay, so when it is ready to use, so I'll start depreciation when it is ready to use. Okay, if there is a component, if you are having the same life, don't separate it. For example, I gave you the example over here, the machinery and the engine. If the life was of the engine was also 10 years, then why will I separate? Both are 10 years only. I will not separate. So the rule is, if they have the same life, calculate the depreciation together. But if you are having the separate life, obviously calculate depreciation separately. I've already given to you. Replacement, I've already told you, de-recognize and recognize the new part. Next, when to end the depreciation? When will you stop depreciating? Obviously, when you sell the asset, or else you haven't sold it, but you have held for sale. That means you're not using it. You will not use it for now. You have stopped using that. You are just in search for a customer. At that time, if you categorize this as held for sale under Ind AS 105, at that time you stop depreciation, right? Whichever is earlier. Next, is the change in method allowed? The answer is yes. Change in method is allowed. That is, you can go from SLM to RBM or RBM to SLM. The change is allowed, and it should be prospectively, not retrospective. That is, you should start depreciation change right from now, not from the previous years. For example, let's say you purchased a machinery. You purchased a machinery for rupees 1 lakh. Okay, 1 lakh. Initially, you were using 10% SLM. So first year depreciation will be 10,000. Second year depreciation will be 10,000. Third year depreciation will be 10,000. The value comes to 70,000 after 3 years. WDV after 3 years, right? After 3 years, what you decided is you will start depreciating at 10% RBM. Is it allowed? The answer is yes, it is allowed. 10% RBM. So what was done in the previous years, don't look at that. The story will start from here. Just don't keep a look previously. That is, 30,000 is already done. You don't have to check for the previous years. Start depreciating RBM from right now. That is, 10% of 70,000 will give me 7,000 in the fourth year, and so on. Right? This is to be done. Obviously, the same should be done with when it is opposite. If you're following RBM first and then the SLM, it should go like that also. That is prospective, not retrospective. Retrospective is from the beginning. So you don't have to go to the beginning. You have to start the change right from now. Okay. Okay. What are the methods allowed? SLM, RBM, and production units. SLM is allowed. RBM is allowed. What is production units? If you are not able to guess the life of the machinery, you can guess the number of units it will make. For example, if you are telling that you have purchased the machinery for rupees 10 lakh and you estimate that 1 lakh units will be made during the lifetime 1 lakh units, and in the first year you are using only 5,000 units are made, so first year depreciation will be 10 lakh into 5,000 divided by 1 lakh. That is, out of this 1 lakh I have used the 5,000 units, that is, I have made the 5,000 units, so obviously it will be production units. Right? So these are the depreciation methods. Obviously, this is not a well-known method, production units, but SLM and RBM are most followed, right? Okay. And the last point in depreciation is re-estimation. Is re-estimation allowed? The answer is yes. Re-estimation is allowed. But from where? Prospective. Now, what do you mean by re-estimate? Re-estimate is very simple. You can re-estimate the residual life. You can re-estimate the salvage value and so on. For example, let's say you have the cost of 1 lakh, the life of 10 years, and the scrap value of 50,000, sorry, 5,000. Okay. So what will be the depreciation? You will say depreciation will be cost 1 lakh minus scrap 5,000 divided by 10 years, that is 9,500. Right? Okay. So you will start with the cost 1 lakh. In the first year, depreciation was 9,500. In the second year, depreciation was 9,500. In the third year, depreciation was again 9,500. Right? 9,500 for the first 3 years. 1 lakh, 927, 28,500. So this will give you as 71,500. This is the WDV after 3 years. Now, what you did is after 3 years, what is the WDV? The WDV is 71,500. The scrap is 5,000, and the remaining life, I will say remaining life, is 7 years. Obviously, you have depreciated for 3 years, right? So remaining life is 7 years. Now what I'm telling is, if you make a change in any of these, it stands for re-estimation. For example, I re-estimated the scrap to 10,000. I re-estimated the scrap to 10,000. So what will be the 4th year depreciation? The 4th year depreciation, it will be 71,500 is the cost right now, that is the carrying amount, minus the new scrap 10,000 upon the remaining life, which is 7 years. And this will be the 4th year depreciation, whatever the answer will be, right? So whenever there is re-estimation, it will be prospectively, not retrospective. Whatever is done has been done, has been done. You don't have to look behind. You just have to go from over here, right? That is, if you're revaluing, re-estimation is at the end of 3 years or at the beginning of 4th years, you have to start revaluing it after the 4th year, not from the previous 3 years. Okay, you have to change it prospectively. Fine, this is done. Now the last point of this IND is the last point, and after that we'll be doing with the questions. Okay, changes in decommissioning liability. What are the changes in decommissioning liability? See, initially I told you that you have to add the present value of decommissioning liability, right? You have to add the present value of decommissioning liability. I told you this. Let's say that it was 5 lakh. So obviously you will not add 5 lakh to it. What you will do is, you will make it at a present value. Let's say the present value comes to 3 lakh, example. So you'll take 3 lakh rupees, right? And then every year you will unwind. Let's say it was, the life was 40 years, and 40 years the value was 3 lakh. Okay, 40 years is a huge time. After 40 years you have to pay 3 lakh rupees. Okay, sorry, 5 lakh rupees. So every year you will unwind. But after 5 years, you came to know that this cost will not be 5 lakh now. This will be 8 lakh now. Obviously it got increased, right? It got increased. So by what amount it will increase? It will not be 3 lakh because you have unwinded it. So how to calculate the amount, I'll tell you afterwards. I'll take an example and explain you the entire concept. But over here right now, what to do of when there is a change, when there is a re-estimation in the decommissioning liability? That is, initially you thought of 5 lakh, but now you are estimating at 8 lakh, or else you can also decrease. So what to increase or what to decrease amount, I'll tell you. But from where to increase or from where to decrease, the point is the model you are chosen. If you are following the cost model, adjust through cost. If you are following the revaluation model, adjust through revaluation. What do I mean? For example, if I say there is an increase in liability, increase the provision. So obviously you will say provision has a credit balance, so provision should be created more. So I am telling you, if you are following the cost model, make the debit to PPE, that is, adjust through cost. But if you have followed the revaluation model, adjust this to revaluation surplus, not to PPE. This is what I am telling. Obviously, if you decrease, it will get reversed. If you decrease the provision, let's say initially you thought of 5 lakh rupees, but now you're telling that it will be only 2 lakh rupees. Obviously, the liability will decrease, right? So you need to decrease the liability. What amount, I'll explain. But what is the journal entry? That is very easy. Decrease the provision. Provision has credit balance, so you'll debit it. You'll debit the provision. 2. You'll debit the provision, and to what? Obviously, if it is cost model, you'll adjust through cost. If it is revaluation model, you'll adjust through revaluation surplus. This is what you have to do. Right? So these are the 2 points, increase and decrease. So I've given the entire concept. Okay. So what are the small points which we have covered? Yeah. What are the small points which we have covered? So we have covered subsequent cost, in which there will be repairs, or replacement or the major inspection. Okay. For repairs, obviously it will be transferred to P&L. But if there is replacement, you have to do 2 things. What are the 2 things? De-recognize the previous part and recognize the new part. Very simple. De-recognize old part, that is removed from books, and recognize the new part. And recognize the new part. Right? Subsequent. Okay. What is the next point? After subsequent, it was depreciation. It was depreciation. From where to start? When it is ready to use, not when it is put to use. It should be when it should start. You should start depreciation when it is ready to use. Okay. What are the methods to be followed? It can be SLM, it can be RBM, and it can be production units. Okay. What about the component? Obviously, I told you if there are two components, life is same, depreciate it together. If the life is separate, depreciate in two different ways. And replacement, obviously, derecognize and recognize, right? Is re-estimation possible? The answer is yes. You can re-estimate, but the effect should be prospective. The effect should be prospective. Okay. Can you change the method? The answer is again yes. Will it be retrospective or prospective? The answer is prospective. The answer is prospective. And the last point which we studied is change in decommissioning liability. Change in or else re-estimation. We have to calculate the amount. This is one of the important questions from exam point of view. Re-estimation of decommissioning liability. So basically there are 2 points. There are 2 points. What are the 2 points? Check whether you are following the cost model or the revaluation model. If you are following the cost model, adjust through cost. Whether there's an increase or decrease. I told you how to pass the journal entry, right? Which is very easy. Adjust through cost. And if you're following the revaluation model, adjust through revaluation. These are the basic points. So I hope everything is covered now and you got each and every point. So how many points are there? First is definition, the second is recognition, the third is initial measurement, the fourth is subsequent measurement, the fifth is subsequent measurement, that is revaluation model, right? At revaluation, what you have to do? Next is subsequent, next is depreciation, then next is re-estimation of decommissioning liability. Every point is now covered. We have done only first question, right? First question was the accumulated depreciation. So obviously, while ending up, I'll take a revision of the revision again, right? But it's time for the questions now. It's time for the questions now. Yeah. So we are already done with the first question, right? Which is the treatment of accumulated depreciation. The second question which I have picked is the excess depreciation. Do you remember the excess depreciation part? We were having an option, right? What was the option we were having? The excess depreciation, the amount of excess depreciation can be transferred from revaluation to retained earnings. If you remember this, this balance sheet, there was other equity over here, revaluation surplus and RE. You have an option, not mandatory, okay? You have an option. It was not mandatory, it was an option to, you can transfer the excess amount of depreciation to retained earnings, right? So that is the question. I'm reading the question. An item of PPE was purchased for rupees 9 lakh on 1st April 21. It is estimated to have a useful life of 10 years and is depreciated on SLM. On 1st April 23, that is after 2 years, the asset is revalued to 960. The useful life remains unchanged as 10 years. The life was again 10 years itself. Ignore the impact of deferred taxes. Calculate depreciation and revaluation surplus for 23-24 as per India 16. Also compute the excess depreciation and its treatment, assuming the company opted to transfer the excess depreciation to RE. They are clearly telling that they have opted for this, right? What I want from you is, I'm giving you 2 minutes window. I want the amount of excess depreciation. I want the amount of excess depreciation. Yes, everyone. Please calculate. Next will be Ind AS 23, borrowing cost. I want the amount of excess depreciation. Okay, 30. Okay, so on 1/4/21, yes, perfect. On 1/4/21, you purchased for 9 lakhs, right? The life was 10 years. Obviously, the depreciation would have been 90 and 90, 2 years, right? 2 years. So the value comes to 720. Now, what you did is you revalued upward by 240. That is, you made the answer till 960. 2 years was the depreciation, right? What will be the depreciation for third year? Obviously, it will be 960 minus scrap divided by useful life remaining 8 years, not 10 years, right? And the depreciation comes to 1,20,000. So what is the amount of excess depreciation? The amount of excess depreciation is 30,000. The amount of excess depreciation is 30,000. So what is the journal entry which you will pass to transfer? There is nothing but you will transfer from revaluation surplus to RE. That is revaluation surplus account debit to retained earning of 30,000. That's it. This was only asked. So I have given the complete explanation over here. First year 90, second year 90. Revaluation gain was 240, 120 and then 840, right? Okay. I'm just adding 1 point to it. Please pay attention, okay? Now, what will be the answer? What will be your answer if in the fourth year, 3 years are done, right? We are done with 840. The value is 840 now. At the beginning of fourth year, what will happen if I revalue downward by rupees 3 lakh? What will happen if I revalue downward by rupees 3 lakh? So I'm just continuing the picture over here. Revalue downward by rupees 3 lakh. Okay. So the value comes to 540. The value comes to 540. Obviously, I'll depreciate, and on 540, the next year depreciation will be 540 minus 0 divided by 7 years this time, because the life is now 7 years, right? This is very easy. I want the journal entry for this downward revaluation. Can anyone give me the journal entry for this downward revaluation? Yes, anyone from you? Can anyone give me the journal entry for downward revaluation? I want with the amounts, okay? I want with the amounts. Yes, given the journal entry for downward revaluation. Initially, there was a revaluation upward, and now you are revaluing it downward. There is a loss, right? So, at what value will you make? And what is the account you will debit, and by what amount? Yes, I want an answer. Quick. OCI 2.4, PNL 3. No, dear. The downward is 3 lakh. Loss is 3 lakh rupees. But you are doing it wrong. Okay. Please check. You have to revalue downward. Okay. Revalue downward by 3 lakh rupees. So the loss is 3 lakh rupees. Ideally, if I tell you, forget the previous gains, the entry should be PNL to PP by 3 lakh rupees. Obviously, this is the entry. But this is the subsequent revaluation, right? Initially, you have already revalued it. So was there a gain previously? The answer is yes. So the loss will be borne by that gain. That is revaluation surplus OCI. But you will not say 240. Why not 240? Initially there was 240. Yes, but do you remember that you have already transferred this 30,000 from it? You have already transferred this 30,000, right? So this 30,000 was already transferred from revaluation surplus to RE. That means I don't have the balance of 240 right now. I am left with only 2,10,000. Are you getting this point? I am left with only 2,10,000. So at this point of time, I have only 2,10,000 with me, not 3 lakh rupees or not 240. And the balance will be borne by PNL, which is 90,000. This is the crux of this index. This is important. This is important. So first of all, there was a loss of 3 lakh rupees. Obviously, the loss should be booked through PNL. I should go to PNL, but PNL, I will not go directly. I'll check whether there was any previous gain. If yes, then the loss will be borne by that previous gain. The previous gain was 2,40,000 true, but it was not 240 completely because I have already transferred 30,000. So I'm just left with 2,10,000. So 2,10,000 will be borne by OCI. The balance loss of 90,000 will be borne by PNL. Yes. Is the point clear to everyone? Please tell me, is the point clear to everyone till here? आया क्या समझ में सबको अभी? Yes, everyone. Is the point clear? Okay. बाकी सब रिप्लाई नहीं कर रहे हैं. Be active. चलिए, moving ahead. So we are done with 2 questions now, right? Okay. Next one. Yes. This was the point I was talking about. I've already discussed this point right now. So again, there's a practice question. So we'll be solving this. Re-estimation and revaluation of asset. Heaven Limited had purchased a machinery on 1/4/21 for rupees 30 lakh, which is reflected in the books at return on value of 1750. Now the only problem over here is they have not given the life of the asset. Life ही दिया नहीं उन्होंने. Please check. Heaven Limited had purchased a machinery. When was the purchase date? It was 1/4/21 for rupees 30 lakh, which is reflected in the books at WDV of 1750 on 1/4/26. That means 5 years down the line, 5 years, the value dropped to 1750. That means they have depreciated it, right? The problem over here is they have not given any life. Can any one of you help me with the life of the asset? I will not read the question ahead. First of all, just reading the first 2 sentences, give me the life of the asset. What is the life of the asset? What is the life of the asset? On 1/4/21, you purchased for 30 lakh rupees. 5 years down the line, the value dropped to 1750. Obviously, it got depreciated out in 5 years, right? Can any one of you give me the life of the asset? Obviously, it is SLM, straight line method. Yes. Can any one of you give me the life of the asset? The only important point in this question is this point. Yes, perfect. 12 years. How come 12 years? See, the depreciation amount was 12,50,000 for 5 years, right? 12,50,000 for 5 years. So for 1 year, it was 2,50,000, right? 2,50,000 for 1 year. The cost was 30 lakh rupees. So for depreciating this 2,50,000 per year, how many years will be taken for to complete 30 years? It will be 12 years. So I've given the explanation over here. 30 lakh was the cost. The WDV is 1750 after 5 years. So the depreciation per annum comes to 2,50,000. 2,50,000, right? After that, 2 lakh 50 is for 1 year. For 30 lakh, how many years will be required? That is, the total life will be required for 12 years to depreciate it completely, right? So the life is 12 years. Now the question is very easy. What you have done? See, there is upward revaluation also and there is downward revaluation also. Okay? And also the excess depreciation has been charged. Let's see what the question says. First stage, we have to calculate the life. The company has estimated an upward revaluation of 10% on 1/4/26 to arrive at the fair value of the asset. That means they have appreciated it 10%. Okay. Heaven Limited availed the option given by Indians for transferring some of the surplus. They have taken the option. That was not mandatory. It was only option, right? There was only an option to transfer the excess depreciation. Okay. On 1/4/28, that is after 2 years again. First it was 5 years and after 2 years again, the machinery was revalued downward by 15% this time, and the company also re-estimated the life to be 8 years now. On 31/3, the machinery was sold for 935. Okay, this was 935 sold. I will not tell about that. First of all, what to do of these things? Let's see. The first point. On 1/4/21, you purchase the asset. Purchase for at what value? 30 lakh rupees. Okay. Then you depreciate for 5 years. 5 years. 2,50,000 per annum. Per annum. Depreciation for 5 years was 1250, right? So the value comes to 17,50,000. This is the WDV after 5 years, right? This is WDV after 5 years. After that, you took the revaluation gain. Revaluation gain of what percent? Of 10%, which comes to 1,75,000. So the value comes to 19,25,000, right? What was the journal entry which you passed? Obviously, the entry would be PPE to revaluation surplus OCI, which is 1,75,000, right? 1,75,000. Okay. Then this was the value on 1/4/26. Then you continued the depreciation for 2 more years. 5 years you were already down. Then you continued the depreciation for 2 more years, right? So less depreciation. What will be the depreciation now? It will be 1925 minus scrap divided by the remaining life, which is 7 years. 5 years were down, right? So what is the depreciation now? It will be 1925 divided by 7. It comes to 2,75,000. 275 1 year and 275 the another year, second year. So you got the value as 1,428 into 2 minus 1925. So the value comes to 13,75,000. 13,75,000 after 2 years, right? Okay. Now, this is the time for downward revaluation. Downward revaluation at the rate 15%. So what is the 15% value? 2,06,250 was the value, and the balance will be the whatever the answer is, right? Now again the question is, what is the journal entry for this downward revaluation? Yes, the journal entry for this downward revaluation. The journal entry for this downward revaluation. I want the journal entry for this downward revaluation. Initially there was a gain and now there is a loss. Initially there was a gain of 10%, now there is a loss of 15%. Please give me the journal entry for this downward revaluation. Quick, everyone. Yes, I want an answer for downward revaluation. No, again you are not getting the point. Yes, Jyoti, the entry is correct, but the amounts are not correct. You missed one line in the question, and the line was, Heaven Limited availed the option to transfer some of the surplus. They availed the option. Remember the option they were having, the transfer the excess depreciation to retained earnings. So what was the excess depreciation? Initially it was only 2,50,000, but now they are depreciating it 2,75,000. 25,000 was the excess depreciation for 2 years, right? So what they have done is they must have transferred revaluation surplus to retained earnings for the 2 years, right? 25 and 25 and 50,000, right? So I don't have 175 in my revaluation surplus now. From that 175, I have already transferred 50,000 to RE. That means the left out balance in revaluation surplus is 1,25,000 now, because out of this 175, I've already used 50,000. So I'm just left out with 125. So the journal entry becomes OCI P&L to PPE. PPE is 2,06,250 true, but first loss will be borne by this OCI 1,25,000. The balance will be transferred to P&L, which is 81,250. Yes, everyone is the point clear till here. 81,250. This was a very small point, but this was very important. The downward is first upward and then downward. So you cannot use the complete balance because you don't have that complete balance. You have already transferred, you already opted for the excess depreciation to be transferred. That was an option to you. Okay, yeah. So I hope this point is clear till here. 3 questions we are down, 2 more to work. So I've given the complete solution. Others, are you facing the same problem? I guess it is completely fine from my end. Just let me check once. My check. I guess it is completely okay. Yeah. Moving ahead. Moving ahead. So I've already also given you the complete explanation and the journal entries also. Not required journal entries, but I've still given to you. Okay. Moving ahead. Okay. So this question is what to include and what not to include. What to include and what not to include, right? Okay. So this is a question in millions. Please don't follow million, make it is zeros. 1 million is 10 lakhs. So 10 million is 1 crore, okay, 1 crore. So I'll go step by step, okay? I'll go step by step. And obviously while typing you will need a lot of time to type. So just answer in your mind itself, okay, whether to add or not. First, on 1st April 21, Sun Limited purchased some land for 10 million, that is 1 crore, including legal cost of 1 million. Is the legal cost necessary to acquire the building land? The answer is yes. Obviously it should be included, that is 10 million, okay, in order to construct a factory. So what was the date of the purchase? It was 1st April. The construction started on 1st May. So to calculate the value of land and building, the cost of the land was 10 million. Can I say it is 1 crore? It was 1 crore. Moving ahead. But the construction started on 1st May, right? Sun Limited incurred the following cost in relation with the construction. Preparation and leveling of the land. Is this cost added? The answer is yes. So I'll write over there, okay. What I'll do is, I will ask you to make the totals, okay. So 1 crore is okay. Then this 3 lakh will be added, right? Purchase of material for the construction. Is the material cost added? The answer is yes. Obviously, whatever the cement and steel will be used, that will be added to the cost of the asset, right? So 6.08 million, when you multiply by the answer by 10 lakhs, it comes to 60,80,000. Just multiply the answer by 10 lakhs. So this will be added. Employment cost, make this point as pending. This is P, pending. Why pending? I'll tell you. Because you don't know the completion date till date. Till now, you don't know the completion date. Overheads cost incurred directly. The word is directly. Will this be added? The answer is yes. 1 lakh per month, this will be added. Again pending because it is per month. Ongoing overhead cost allocated. The word is allocated. That means general overheads. General overheads won't be included. Never ever the general overheads. This will be a part of P&L. Income received during the temporary use of factory premises as a car park. Remember the car park point? This will go to P&L. This will not be subtracted from here. If it was testing income, it will get subtracted. Okay. Cost of locating the employees, it will not come. Cost of opening ceremony inauguration, no, it will not come. Right. So basically there are only 3 costs and 2 costs are remaining. The factory was completed on 30 November. Please tell me how many months? How many months was the construction? How many months got the construction completed? Please tell me how many months? I purchased the land on 1st April, started with the construction on 1st May and ended on 30 November. Ended on 30 November. Please tell me. Ended on 30 November. Yes, it is 7 months. That is May, June, July, August, September, October and November. 30 November. That is 7 months, right? Okay. So basically you have to add 7 months. So 2 lakh into 7 months will give me 14 lakhs. This will be added, right? And 1 lakh into 7 months, 7 lakh will be added. So whatever we are adding, I'm just highlighting it so that it will be easy for you to add the balances at the later stage. So what I have added till now, 1 crore, then 3 lakh, then 60 lakh, 80,000, then 14 lakh and 7 lakh. I have not added any of these costs. None of the 4 costs. Okay, moving ahead. So the factory got completed on 30 November, which is considered as substantial period of time as per Ind AS 23. That means interest borrowing cost, if you remember, Ind AS 23. And production began on 1st February. Production was on 1st February. You completed the asset on 30 November and the production began on 1st February. The overall useful life of the factory building was estimated at 40 years from the date of completion. However, it is estimated that this is not F, this is roof. The roof will need a replacement of 20 years after the date of completion. Remember the component part. 2 different lives. The first life is 40 years and the second life is 20 years. It will be depreciated separately. And that the cost of replacing the roof at current prices would be 30% of the cost of building. That means 70% is the building and 30% is the cost of the roof. So we need to separate the values and then depreciate it. Okay. At the end of 40-year period, Sun Limited has a legally enforceable obligation to demolish the factory, that is provision for decommissioning, and to restore the site at its original condition. The directors estimate that the cost of demolition in 40 years based on current year's price will be 20 million. 20 million, that is 2 crore rupees. An annual risk adjusted discount rate which is appropriate to this project is 8%. The present value is 0.046. So just multiply with the present value. 2 crore into 0.046. 46 into 2 will give me 9,20,000. Am I right? 9,20,000. Just 1 minute. 0.046 into 2 crore. Yeah, it is 9,20,000. Right? So obviously this will be added. This will be added. Okay. One more cost is pending and that is the loan cost. Okay, moving ahead. The construction of the factory was partly financed by the loan. This was the amount I was looking for, 17.5 million. Taken out on 1st April. You took the loan on 1st April. The loan was at an annual rate of 6%. Sun Limited received an interest investment income. Okay, I will not talk about this investment income right now. Please tell me, if you have taken the loan on 1st April, how many months you can capitalize? For how many months you can capitalize the interest? If you know the borrowing cost, if you have already studied the borrowing cost, can you please tell me how many months can you capitalize the borrowing cost? That is the amount of interest. The amount of interest. The amount of interest, 17.5 million into 10 lakhs will give you 1.75 crores. 1 crore 75 lakhs. So it does not matter when the loan was taken. The point is, when was the construction started? The construction got started on 1st May. If you plot on the number line, 1/4 was the loan taken. It hardly matters. You have taken the loan, it hardly matters. The point is, you can start capitalizing on the date when the construction started, that is on 1st May. You will start capitalizing from here till here, 30/11. That is only for the 7 months period, not the 8 months period. Only for the 7 months period. Plus, If you receive a temporary income on that, you have to subtract that because you are adding to the cost, so income will get subtracted, right? So the interest, the amount to be capitalized in the name of borrowing cost, will be 1.75 crores into 6% for the period of 7 months. But you have to subtract 1 lakh, the temporary income, from that. Now, who can recall borrowing cost, it is good. If not, I'll be taking it in the tomorrow's session, that is India's 23. I'll be taking completely. So in that also I'll be taking these concepts. Okay. Now, what is the amount? 1 crore 75 lakhs into 6% into 7 by 12 minus 1 lakh. It comes to 5,12,500. It comes to 5,12,500. Okay. So can you please add up the amounts now? It is 1 crore plus 3 lakh plus 60 lakh 80,000 plus 14 lakh plus 7 lakh plus 9 lakh 20 of the decommissioning plus 5 lakh 12,500 of the borrowing cost. Can you please give me the total cost of the asset? The total cost of the asset. 1, 60, 14, 18, 21, 81, 84, 93, 98, 90, 99. 1 crore 99 lakhs 12,500. Please check everyone. 199 12,500. Let me check the answer. Yeah, 1 crore 99 lakh 12,500. Perfect answer. Yes, perfect answer. Right. 1 crore 99 lakh 12,500. Now, the important point is what they've asked. They've asked the carrying amount of the factory on 31st March 22. You started construction on 1st May 21, but they have asked the value on 31st March 22. 31st March 22. That means obviously the life, you have to separate it 70 and 30, right? Can anyone tell me for how many months will the depreciation be charged? You started production on 1st February. For how many months will the depreciation be charged? Over here we have also component accounting. For how many months will the depreciation be charged? Every single point is covered in this question. Yes, the point on depreciation was depreciation will start from the date it is ready to use, not put to use. It hardly matters on which date are you using it. Was it ready on 30 November? The answer is yes. So you should start depreciation from 30 November itself. So from 30 November, that is December, Jan, Feb, March, you will start depreciating for 4 months. But the problem is, can I directly depreciate this 1 crore 99 lakh 12,500 for 4 months? The answer is a big no. This has two components, right? 30% and 70%. Ideally, students do like this, but this is incorrect. Because there are not two components, there are three components in this. What is the third component? The third component is land, which was of 1 crore rupees. And land is never depreciated. Land is never depreciated. Every single point was covered in this question. Land will not be depreciated. 1 crore is the value of land. Therefore, if 1 crore is the value of land, the value of building comes to 99 lakh 12,500. The value of building. In that also, there is a roof and there is other building, which is 30% and 70%. So you need to bifurcate this. And the roof has a life of 20 years and the building has a life of 40 years. 20 and 40. And now you need to depreciate. So it will be 99 lakh. Okay, I've already calculated and not waste the time. Yeah, over here. The value of land is 1 crore. and the value of building is 99,12,500. 30% of which is apportioned to roof and 70% is apportioned to the other part of the building, right? Now, for depreciation, I will obviously depreciate 2973 divided by 20 years because the life was 20 years, and I'll depreciate only for 4 months. This is the value, first point. Second, this 1638 will be depreciated in over the period of 40 years. For first year, I'll depreciate for 4 months. And this will give me the total depreciation of 1,07,386. 1,07,386. And now the value becomes 1,98,05,114, which was asked in the question. The value becomes 1,98,05,114, right? Okay. And now the last point of this int is, that is, what about re-estimations? What about re-estimations? See, I'll give you the perfect example, okay? I'll give you a very small example. Let's say I purchase the asset, for rupees 1 lakh, right? For rupees 1 lakh, and restoration cost, restoration, this decommissioning liability, was rupees 4 lakh after 5 years, and the discount rate is, you can write this question with me, along with me, okay, because this will not be there in the handwritten notes. Discount rate will be 10%. So what is the purchase entry? Let's say on 1/4/2021, let's say. What is the entry of the purchase? So you'll say PPE account debit, to bank or the trade payables, to provision for decommissioning, right? To provision for decommissioning. But decommissioning, the amount will be 4 lakh divided by 1.1 to the power 5. 4 lakh upon, that is present value of 4 lakh, right? So I'll calculate the present value. It is 4 lakh divided by 1.1. It comes to 248,369. Please correct me if I'm wrong. 248,369. Then it is 10 lakh, sorry, 1 lakh. And the value will become 348,369. 348,369, right? Okay. At the end of each year, obviously you'll depreciate also. And you will also unwind. So what I'm asking for is, I need the two tables. Okay. Obviously, this is unwinding. It will start from the end of the year, right? So it will start from 31st March 22. This will be opening. This will be interest at the rate 10%, and this will be closing. So you have started with 248,369, right? And 248,369, you will say 10% is the interest. It will come to 24,837. Just add up 248,369. So this comes to 273,206. Next year, that is on 31st March 2023, 273,206 into 10% will give you 27321 plus 27321. This will give you, sorry, 300,527, right? Okay. Next is 300,527. 300,527. Again, 10% will give you 300,053. Just add up. This will give you 3,30,579, 580 on 31st March 24, right? Okay. 2 more years to go. On 31st March 25, 330,580 33058. This will give you the answer as 363,638. And the last year, 31st March 2025, 363,638. I'll say directly 4 lakh. This will be the balancing figure, whatever the balancing figure is. Last year, I will take the balances. It is 36362. Exact amounts come to 36362.4, but that's okay, right? So basically, I have made the unwinding table. I have made the unwinding table every year. Every year, I'll use this, right? Okay. But what about depreciation? Depreciation each year. So you have the opening value of the asset, which is 348, 369, and obviously the life is 5 years. 348, 369 divided by 5. So the depreciation will be for each year 69,674. Depreciation 69,674 every year, right? 69,674, 69,674, and so on. Okay, so I'll write for first 3 years only. Closing will be closing 348,369 minus 69,674. It comes to 278,695. 278,695. Again, depreciate 69,674. You will get the value as 2,09,021. Right? I'm just talking about the first 2 years. Okay. Now, what exactly happened? What exactly happened? If I ask you the journal entry for this, you will say interest to provision, right? Interest to provision, obviously. Again, the provision amount will become 273. Again, interest to provision each and every year. This is nothing but depreciation to accumulate depreciation or PPE, whatever the case is. I'll do it like this, right? I'll do it like this. But what happened is after 2 years, okay, that is at the beginning of 3 years, at the beginning of third year, the restoration expenses were re-estimated as rupees 7 lakh this time, sorry, 6 lakh this time. Initially, you took at 4 lakh, but the problem is now you're telling no, it is not 4 lakh, it is 6 lakh now. On which date are you talking? You're not talking about on the first date. So basically what is happening is, this was year 1, this was year 2. At the end of year 2, year 3, 4, 5, over here at the end of year 5, you're telling 6 lakh. So now tell me at what value should I record? Obviously at the present value, but you will not discount it for 5 years. 2 years are already down. So you will discount it only for 3 years now. You will discount it only for 3 years now, because 2 years you are already down. 2 years it was already done. It was not retrospective, it is prospective right from now. So we will not say we will discount it for 5 years. You will discount only for 3 years. So what is the discounting? So it will be 6 lakh divided by 1.1 is equal to. So you should record the provision at 450,788. That is, the present value of the provision should be 450,788. Current year, right now. At the beginning of third year, it should be 450,788. But at the beginning of third year, what value are you having right now? Can I say you are having 300,527 in your provision account? Because you have already unwinded the interest, right? So after 2 years, your value was 300,527, but now you are telling the value should not be 300,527, it should be 450,788. Do you need to increase the value? The answer is yes. By how much? By the difference. By the difference. And that's why I made the entire table with you. Okay. So what is the current value? The present value of the re-estimated amount. It will be 450,788 minus the current value in your books. Current value in the books. It is 300,527. So can I say you need to increase the provision? You need to increase the provision, right? So increase the provision increase the provision by what amount? So it will be 450,788 minus 300,527. You need to increase, just 1 minute, 450,788 minus 300,527. You need to increase by 150,261. Now to increase the provision, the rule is very simple. The rule is very simple. What is the journal entry? To increase the liability. Increase the liability. What is the journal entry? You will say provision should be created because any provision is a liability, right? You should increase the provision by 150,261. This was the last point I was talking about. I will tell you the amounts in afterwards, right? So this is the amount 150,261. Okay. What will you debit? So you will ask which model are you following? Are you following the cost model or are you following the revaluation model? If you are following the cost model, adjust through cost. If you are following the revaluation model, adjust through revaluation. Since it is not given, I'll assume it to be at cost. Since there was no revaluation in the complete year, I will say the value will be 150,261. This is the entry to be done on 1/4/2023. That is after 2 years at the beginning of third year, right? Okay. Now what will be the depreciation for the third year? It is important again. Depreciation for third year. So have you changed the value of the asset? The answer is yes. So what was the value after 2 years? The value after 2 years was 209,2021, right? So what you have done is you have added 150,621, if I'm not wrong, 150,261, sorry. Can I say you have debited the PPE account? Yes. So the value is now the new value of PPE becomes 209,021 plus 150,261. It comes to 359,282. 359,282. This is the value of the new value of PPE, right? And now, what is the life? The remaining life is 3 years now. The remaining life is 3 years. So what will be the depreciation amount? It will be 119,760, the depreciation for third year. The depreciation for third year. I hope you got this point. The depreciation for third year will be this, right? I'll repeat the entire procedure. See, first of all, what happened was I purchased an asset for 1 lakh rupees and the restoration was 4 lakh after 5 years. After 5 years, I have to pay 4 lakh. So I will not record at 4 lakh, but at the present value. The present value came to 248, 369. Every year I'll unwind. For 5 years, I gave you the unwinding process. For 5 years, I gave you the unwinding process. But the problem was at the beginning of third year, you changed the estimation amount. You are telling that it will not be 4 lakh, it will be 6 lakh now. Obviously, you are standing over here. After 2 years, you are standing over here. And you are telling you have to pay 6 lakh 3 years from now. Not 5 years, but 3 years because 2 years already down. So what I have done is I have made the present value till 3 years. 6 lakh, the present value of from 3 years will be 450,788. But currently in my books, the value is 3 lakh 527. So I need to increase the provision. To increase the provision, I have to credit the provision amount. But debit what? So you have to check what method are you following. Is it cost method or is it revaluation method? If you are following the cost model, adjust to cost. If you are following the revaluation model, adjust to revaluation. Since it was cost, the cost got changed and therefore the depreciation will change. The depreciation will now become 119,760, and this is what is to be done when there is revaluation. So I hope you got this point. If you have any query till here, please let me know. If you have any query, please let me know. कुछ भी प्रॉब्लम है तो प्लीज मुझसे पूछो अभी. Yes, if you have any problem, please let me know. Okay, so I guess you got this point, and this was the last question. One question I have already given in the sheet, which is the same question, which is the similar question, not the same, which is a similar question, which I just explained. This one is for your practice. Okay, so even if you practice these 5 questions, all the concepts of this Ind AS are already covered in this. Relocation costs are never added with it. Relocation costs are never added to the cost of the asset. we've already discussed this point. Relocation. Just 1 minute, I'll tell you. Yeah. See, over here. Does not include inauguration, advertising, training, admin expenses, general overheads, initial operating losses, cost of relocating entities operations, and so on. So these are never added. Yes. Any other query? Any other query? Well, yes, not. So yes, this was all about India 16 PPE. I hope everyone got this point, and as I told you, I'll be live for the entire week and I'll be covering 1 or 2 Indias depending upon the size of the Indias, right? So I'll be covering those Indias and I'll also be taking the important Indias such as your business combination 103, the complete part of that 103, 109, 110, everything, financial instruments. I will be taking everything. Okay. So tomorrow I'll be taking Indias 23. Make sure you are attending live with me at 5 p.m. Okay. Well, that's it for today.